You can have a proper system, but without proper psychology, you're not going to be able to execute well. Some of these new terms that come out for like pre-existing concepts that have been around for so long, there's some new concept called CRT now. It is literally just a sweep of a high or a low, but it's been given a new name now. So I think it has to do with the shiny object syndrome too, right? To appeal to new traders so somebody can build a platform off of it. There's a lot of good information, but at the same time, there's a lot of bad information as well. So I think as a new trader, if you come into the market and you end up following the wrong guy or wrong information gets put in front of you initially, then that's gonna severely hinder your ability to become profitable in a short period of time. A lot of new traders, they get attracted to the numbers that they see. It's cool, like you can put out a dollar P&L, 10,000, 50,000, whatever it might be. The one thing that I look for is if you can call the markets live, that's the differentiating factor between somebody who is a proper trader versus somebody who is obviously just marketing. I think it's actually better to start off with these prop firms because you have a daily loss limit. Some of them have a consistency rule, so you have to be consistent to get a payout. And I think it forces you to be more disciplined as opposed to you starting a live account and losing the entire thing.
There's a trader that I had on the show, Mark Hutchinson. His approach was that if a system is truly mechanical, if you just gave that to 100 traders, the only reason some would be profitable and not be profitable is the mind. In your experience, how important is psychology? Ladies and gentlemen, welcome back to another episode. We are joined by Keyflow. I'm going to say your name. I'm going to snitch. Harris.
That's okay.
So yeah, I only just met you recently, so I haven't had a full chance to do my due diligence. So let's jump right in and explore your life and your trading journey. The few things that you mentioned is you're an options trader and that transitioned into futures. And that's a very common thing, it seems like, in the US, as we were just saying, in the UK and Europe. No one does it. Everyone's in FX and that's all we know. And it seems like in the US, everyone is options, futures, and no one touches FX.
Right.
And my side, looking at options, is like just straight up gambling. It's just you have a time limit and it's higher or lower. So when you're coming from that kind of base, what does it feel like to then transition into futures, which is actually something a bit more stable and serious?
So when I was initially trading options, that was my main complaint with options was the Greeks, the expirations. There's so many factors going against you, so it's very difficult. And when I found out about futures it was 2 years into my options trading journey, how it's essentially the same thing. It's still leveraged, you can make money. That's when I was like, okay, this makes a little bit more sense to transition into. So, and at the time I was only trading, I primarily throughout my entire options career only traded SPY and QQQ.
Okay.
So it made more sense for me to switch over to futures because I was still trading the same assets. So the strategy itself didn't change much, but now it was better for me because of no Greeks, no theta expiration, none of that. So
I got a bit of an interesting question. So you have obviously SMC, ICT, and this is something that ICT and SMC traders are usually in the FX world, and now we see that it's working just fine for you in the futures market and also in the option stocks and all these other assets. Let's say, why do you think that these concepts can work in every single market? Would you say it's kind of the laws of the market, or why do you think it's so stable in every approach?
Yeah, I think it is the laws of the market. So what I personally trade is very, very simple. It's the PO3, which is open, high, low, close, open, low, high, close, which doesn't rely on any indicators. Like every single asset, regardless of what you trade, has an open, high, low, close. It's just candles. So that's why I think it's applicable.
Just to summarize, because I'm not following. Power of three, I don't know entirely what it is, but open of the candle, high of the candle, and low of the candle.
Yeah.
And then within that candle, you're taking a trade. Or if you could just describe power of three.
Yeah, so power 3 refers to accumulation, manipulation, distribution. And then, so each candle, regardless of whatever time frame, has these 3 phases within that candle, right? So the body of the candle is typically your distribution, and the wicks are going to be the manipulation. And that open is the accumulation, right? Okay. So the goal is to position yourself within a wick and then catch that body, right? And that happens across any asset class, any time frame, doesn't matter. I typically trade the 4-hour PO3. I think it's easy, and it gives me 2 trades per day guaranteed, right? In the New York, there's 2 4 hours that open up, the 10 a.m. and 2 p.m. So that's why that's what I trade.
Just to have common terms, so accumulation, distribution, and what was the third one?
Accumulation, manipulation.
Accumulation, manipulation, distribution. Yeah. Are you referring to accumulation as a zone of consolidation, or accumulating orders to then go up?
Yes. It's not always as clear as a zone of accumulation. Okay. So that accumulation portion of the PO3, I refer to as the open. So the open of a 10 a.m. candle, it'll accumulate a little bit, and then it'll manipulate into whatever PD array is there.
But accumulate meaning like just horizontal price action. It's just a little bit of consolidation.
Doesn't necessarily have to be horizontal. Sometimes it is. Sometimes it's clear like that. But oftentimes it's not. It might accumulate a little bit higher, a little bit lower. But the point is that it is accumulating towards a PO3, which, or towards a PD array, which is going to manipulate into. Okay.
And that manipulation is manipulating the open itself, or is manipulating something else on the left?
Yeah. So you have the open, and if you're bearish, then you're looking for a PD array above the open that you would then short.
Okay, so similar to as we just had with Shinobi, it's you're looking for a sweep of liquidity, and that's your manipulation, and then distribution is that reaction you're trying to catch.
Yeah, into the opposing draw on liquidity. Yep.
So I think a lot of traders actually, and myself too, is probably a mirror of something similar, which is we're just looking for liquidity and manipulation, because we know right after that cause there's the effect, and just the laws of the market. If you have enough liquidity in the market, you're going to have a movement. So if we can correctly time the right zones and the right signatures of a manipulation, we're more likely to get a meaningful move. So, I mean, I've spoken at length on mine on this channel on how I would reflect these three areas, but how are you looking to identify liquidity on the left, let's say, and then how are you correctly identifying the manipulation, and not just, let's say, higher highs, but actually something that is manipulative, and then a safe way to get into the reaction to actually trade that manipulation?
Yeah. So liquidity for me is external highs and lows and internal, right? So two types of liquidity, external and then internal. External would be the highs and lows of a given range, and then internal would just simply be fair value gaps.
Are you linking that to a time frame, by the way? Like anything above the M15 is external, for example?
Yeah. Okay. I would say.
Okay.
Yes.
So you're utilizing the external range liquidity for the sweep, for the manipulation, and then the fair value gap as the entry point.
As the entry point, yeah. Okay. So the my entry will always take place after those 4-hour candles open, right? So if we have a high or a low that gets swept, that is the sweep of external highs and lows is a reversal. And then a sweep into internal to go to external is a continuation move. So it's much easier to trade that internal to external versus external and internal, right?
Because you already have the first domino that's
exactly.
So you're following the sequence afterwards.
Right. Okay. Right. Very, very easy. So
and have you modeled this out in terms of like plays and setups?
Yes. Yeah. 100%. So my entry model is what you were saying is the safe way to actually enter is a confirmation model, which is after we get a change in state of delivery on the aligned time frame. So if we have an hourly fair value gap and I'm looking to trade internal to external, and we have hourly fair value gap and then an opposing high, I'm waiting for the 5-minute to get a change in state of delivery out of that 5-minute gap or out of that hourly gap. Okay. So I have a checklist, and there has to be SMT, a liquidity sweep, which would be internal liquidity sweep into the fair value gap, and then the change in state of delivery on that aligned time frame.
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow. What is your aligned time frame? Is it a specific window, or is just anything in the open of the session?
So it's just two time frames that align. So a higher time frame that aligns with a lower time frame. Okay, yeah. So hourly PD array would line up with a 5.
What about time of day as a time frame? Sorry, and like I only trade this window of this 1 hour, 2 hour window, or is there any portion within your 4-hour candle?
Yeah. So typically my entries will take place between 10, and maybe it'll happen right away at 10. Between 10 to like 11 is usually when you can get your entries. And then from 11 to the next 4-hour candle, it's usually the distribution phase of that candle.
Okay. You know, I'm finding this very interesting because I don't. Maybe this is a common one, but I don't think I've ever come across it myself. We're trading just the 4-hour candle, and are you trading that 4-hour candle independently, just whatever's happening inside, or are you taking the context of the last 4-hour candles and the previous day and the highs? Like, are you doing a full top-down analysis, or is all within that candle?
There's always a top-down analysis every single time, because each PO3, each 4-hour candle, each candle is a continuation of the previous one, right? It's a reflection of the previous one. So I do have to take into account what's happening on the left to account for what's going to happen on the right.
What would you say is, let's say the 4-hour candle you're looking to trade, what would you like to see in the previous 4-hour candle or the previous few 4-hour candles that would support a thesis in your trading handle?
So if, let's say we're making a move from internal to external, from a fair value gap to a high, and the previous 4-hour candle is delivering out of that fair value gap and has not yet reached that external high, I would like to see that next candle, the one that I would trade, to go open low, high close into that external high. Okay.
And within this, are you utilizing market structure, or is it just external and internal liquidity?
I don't. So inside of that internal to external move, you're gonna get a lot of market structure shifts to the downside, fake market structure shifts. So the market structure that I'm utilizing is the higher time frame market structure. So whether that's the hourly or the 4-hour or the daily, internal market structure on a smaller time frame, like a 15-minute or a 5 or a 1, I don't give too much weight to it.
Interesting. And are you always closing out when the 4-hour closes? Is that your final TP?
Yes. Usually when the 4-hour closes, I'm out of my trade. Or maybe sometimes even before the 4-hour closes, I'm out of the trade.
So what are you looking for to exit a position? It's not just the close, is it? When you've completed the internal to external range?
Yes.
Okay. Is internal to external range just a lower high to form a lower low? Just when you've had that market impulse?
What do you mean?
In a bearish market, you've taken entry based on internal liquidity, and then you're trading it to the external to make that new market structure lower low. So once you've swept that low, is that your exit?
Yeah, that's a safe. That's the low hanging fruit, right? I mean, that low is guaranteed.
Yes.
Anything beyond that low, we would have another 4-hour candle open or whatever candle opens, and then that would go. If it was to be a bearish continuation, it would go open high. And then low and close, right? So if anything, I can get another entry on that following 4-hour if I really need to. But typically for me, I'm happy with once that internal to external move is complete, I'm happy with those gains. I lock it up and call it a day.
You know, this is an interesting topic to touch on, which is when you're in a trade, determining what you're going to do next. If you're going to hold, if you're going to add, if you're going to take profit early, move things, all these considerations, thoughts come in. And we have to be careful because these thoughts can also just be voices in our head, emotions saying, oh, you've made enough money to take it, but maybe it's not the right thing to do from a strategy perspective. So in my earlier days, I would be trading from levels and say, okay, I'm going to take profit at the sweep of, the lower low, let's say. And then it might be, the higher time frame structure. And I'd have all these levels that I could take profit on. And every trade I would kind of do it a little bit different based on what I felt, based on what I saw, based on a bit of intuition, let's say. And I always found, let's say, random results. When I changed my system to just fixed levels based on a risk reward, actually, it's just I 1 to 3 and a 1 to 10, I'm always out, no matter where the liquidity is, no matter what anything else is. And it might seem counterintuitive because you're leaving money on the table at certain times, but the reason I did it is because I didn't want to optimize my system for the wins. I wanted to optimize my system for the trades that went in my favor and reversed. Those little portions that I could have caught. And what I found is when I'm just taking very early partials, just right after the impulse, that pays for my next loss and it keeps the account ticking. So, long story short, I built an account management system. Now, in your process, because it seems like you have your targets, you might take something, and then the next 4-hour candle, you're waiting for the power of 3 again to see basically, is this going to continue in my favor? So are you doing your profit taking based on levels or based on how price action is moving along the way, and you decide in the trade?
Yeah. So my risk to reward is always a 2 to 1 at a bare minimum, right? Okay. Now, sometimes I can choose to take profit at this 2R if I see that basically I trail my stop loss, right? As the position goes in my favor, my stop loss gets trailed to the next PO3 that gets created under it, right? In a bullish scenario. But majority of the time, if I have a plan and I've mapped out the risk to reward, I know that this is my entry, this is my target, I will hold it for that target to even take my first TP.
Okay.
Right? Because what I found was that sometimes I would be exiting early, and what will happen is I planned out a 2-hour trade, but I realized negative R multiple, right?
Yeah.
And in the moment, it's fine, it's good. You took a green trade and you closed out green, great. But longevity-wise, that would just come and bite you in the, you know what I mean? Like, it's just
People don't think about that.
Yeah. So once I found that out, and I figured out, like, because I was starting to, you know, my wins would be small and my losses start to get big for that reason. So I started just holding my trades to those take profits. That trade the plan the trade, or plan the trade the plan, right? And that's what I do now. I stick to it. So if it goes through an internal low or an internal high, but my plan is to take profit at that external high or low, I will be holding it for that. I'll just trail my stop loss. So that way, you know, once the trade has made a new PO3, I'm well in the green. Like if I'm 100, 200 ticks into the green, I'm obviously not going to let that trade go back to break even or end at a loss. I'll trail my stop loss. I'll break even or I'll take profit. It'll stop me in profit. But I never just exit early because I see a dollar amount or, you know, anything like that.
With this statement that you said, which is plan the trade the plan, it seems like you have your targets along the way, but then there's also these other thoughts of, I can't let the trade come back to break even. And this was a big voice in my head too, which was, okay, I have this, and this is when I was actually swing trading. So I'd have these targets that might take a week, 2 weeks, 3 weeks to hit. And obviously news events can screw that all up. So this voice started to grow, which is, okay, if I hit the final TP, I lock in a huge amount. So this is brilliant. But what about all the times that it got close and then just went back to break even? My younger head was like, oh, well, it wasn't a loss. It was a break even. And it sounds similar to what you're saying, which, you know, it is what it is and on to the next. But longevity wise, that's a huge inefficiency, because if you've had at the end of a year, at the end of, let's say 300 trades, you could have locked an extra 50%, but you let it go to break even. At least it wasn't a loss. Well, that's a huge portion that you could just do something with, which for me then both my fixed levels. So when it comes to breaking even, it seems like you're just putting a trailing stop. Why do you choose a trailing stop as opposed to just aggressive partials along the way?
Because majority of my trades, when I plan it out properly, so I stick to only A+ setups, right? I have a checklist that I follow, and those are the only trades that I take. Besides that, I don't take anything else. And because the nature of the model that I'm trading, it's an aggressive expansion that I'm trading, 9 times out of 10, that external high or external low, whatever target that I've planned out, ends up hitting. Sometimes, some days, it's a bit of a choppier move. But after back testing this and collecting all the data from the hundreds of trades that I've taken, I figured out that it was more beneficial for me to trail the stop loss and let the trade just have some breathing room to go hit that initial target that I planned out, as opposed to just taking aggressive partials through the way. Another reason why I don't take partials is because I'll typically only enter trades with smaller size. I'll enter a trade with 1 to 2 minis at most. So scaling.
Just for reference, because I didn't understand what exactly that was. In terms of risk management as a percentage of your account, what does that look like for you? Or is that even how you're looking at it?
So not really how I look at it. So 1 mini is on the NASDAQ, it's $20 per point. Okay. Right? So you can make a lot with just 1 mini if I'm looking for a 50-point target, let's say, right?
Okay. But in terms of, obviously you have your stop loss and therefore calculated risk, how are you doing that? Is that based on percentage? Is that a dollar amount?
It's never based on percentage. It's just based on the chart. So I'll enter the trade, and where my idea gets invalidated is where I'll have my stop loss. I try to make it around 0.5%, no more than 0.5%.
Of your account?
Of my account.
Oh, so actually rather conservative.
Yeah.
Compared to a lot, at least.
Yeah.
And therefore you are doing a risk reward game, not a points count game.
Yeah, no.
Okay. Interesting, because actually I've had a lot of traders, and it's something that's been brewing in my mind, which is a lot of traders are always just taught do the risk reward, what your stop loss was in terms of dollars to compare to your take profit, and that's your risk reward ratio. But are you trading only one asset class, or are you trading a few?
Usually just the Nasdaq.
Yeah, so this is what someone told me, is like, if you're just trading one thing, you might take a loss one day and then a loss another day. But if you just took the pip count in FX, you just accumulate the pips and your positive and negative pips, and it was just another approach. But anyway, a side topic. So you're doing a percentage risk, 0.5% approximately, and break-even protocol. Do you have a break-even protocol? If you don't trail the stop.
Yeah. So I mean, my break-even protocol, if price gets through an internal low or an internal high while I'm in a trade, I'll usually end up moving that stop loss to break even, because if it breaks through an internal high or an internal low, ideally it should continue in the direction it's going instead of reversing from there. If it reverses, good chance you might get stopped out. So it's better to just move the stop to break even at that point.
Mm-hmm. I want to focus on the word you mentioned earlier as part of your power of theory, which is the word manipulation. Talk to me about how you identify it, and how you can qualify it from a real manipulation compared to a fake out, just a push high, let's say.
Right. So it's really dependent on the overall narrative of the chart, right? So like I said, every PO3 is a continuation of the previous one. So if the previous PO3 hasn't completed the objective, meaning it hasn't gone from internal to external or external to internal, hasn't completed that objective yet, just means that the following PO3 is just going to be a continuation of that until it hits that objective, right? Price will not randomly reverse and go from external back to external. It's not going to happen. It'll complete the objective and then it'll do that. So what I'll look for this manipulation, it's always time-based, because it's not going to happen until that candle opens, right? Because every single candle has that open, high, low, close. So the manipulation for this 4 hour is going to happen after that 10 a.m. opens. It's not going to happen at 9 a.m. It's not going to happen at 8 a.m. It's going to happen after 10 a.m. opens up. 10 a.m. is going to open up, and really, if I'm bearish, and like I said, if that internal target has not been hit for going from external to internal, then all I'm looking for is the immediate PDRA above the candles open, right? Whether that's in premium, whether that's in discount.
Okay.
And that is the one that I'll look to take a trade off of. So if it's, let's say it's a 15-minute PDRA, then I'll drop down to the 1 minute and get the checklist, SMT, change in state of delivery, and then I'll enter that trade.
Okay.
So yeah, and in terms of, fake manipulation versus real manipulation, I always wait for the 10 a.m. to get a real manipulation, right? The 9:30 is usually like you usually get a nice Judas swing in that 9:30, because that's the New York Open. But I will, in my experience, whatever happens at 9:30, 10 o'clock is typically a continuation of that, and we still get a manipulation leg in the 10 a.m.
Okay. Why do you only choose to trade one asset class as opposed to just, because what I'm gauging here is you have your A+ setup, and it's a very rule-based checklist one. So therefore, unless it doesn't meet the full criteria, you're not taking the trade. So I would imagine a lot of times good setups that are not great, it's not in your A+, they were just good, you let them go. So traders that I've had on the show that are in this situation where they only focus on A+ setups, they compensate for those missed trades with just looking for A+ setups elsewhere across the markets. Why have you chosen to just stick with one?
Honestly, there's really no specific reason for that. I've just always traded NQ, and it's something I'm comfortable trading.
Okay. How often are you able to find a good trade, or let's say, A+ setup for yourself?
I would say at least one a day will show up.
Okay.
Whether that happens in Asia, London, or New York, one a day will typically show up.
Every day you can basically take a trade?
Yes.
Okay, that's pretty often.
Yeah, pretty often. So sometimes the market conditions aren't so great. So even if an A+ setup shows up, I'll stay away from it, because if we have SMT divergence going against the setup or whatever the case might be, like NFP, non-farm, those are typically days I don't trade. Doesn't mean an A+ setup won't show up. Probably will, but I just won't trade it. because even if it shows up, there's a higher probability that that setup does not work out just due to the conditions.
Okay.
So I would say out of 5 days a week, I'll probably end up taking 5 trades usually.
Oh, crazy. Okay, so you don't need other assets.
I don't need other assets.
You're trading actively.
Yeah, a lot of my students will trade other assets. They'll trade gold because the concepts work on everything. Like I say, they'll trade Forex. A lot of them trade EU, GU, whatever the case might be. But it's something I'm comfortable with, so I just stick to it.
So when people are trading something else, obviously your strategy is pegged to SMT, the divergence. What would somebody look for divergence in if they're trading gold or they're trading an EU? What is the right thing to check the divergence with?
The correlated asset. So with EU, you would check GU, right? I'm not 100% certain with Forex.
I think EU and GU is the major.
Yeah.
Is the major. They follow each other very well.
Yeah.
Yes.
So you would look for a crack in the correlation between those two correlated assets. With gold, you would look at silver, right?
Okay. And can you explain to me, because we just had obviously a friend Shinobi on, and SMT to me was the term smart money trap. So I'm looking at manipulation of typical smart money zones, whereas SMT for you is the smart. What was it?
It's the smart money technique. So it's
smart money technique.
What we're looking for is the SMT divergence.
Yes. I've kind of vaguely understood what it is. It's kind of like highlighting a manipulation because they should be correlated. One's depegged, so therefore something is not right here. What is? Do you just follow it because you've seen it work? So do you understand exactly what's causing it and why that is happening? Why does price depeg and actually temporarily do this divergence to then follow through?
I'm really not 100% sure. I'll be honest with you. It's just it works.
Sometimes there doesn't need to be an answer. It's the same for me, like smart money traps, like this thing of typical equal highs and then a sweep, a push down, and then that getting swept, and then the real move happened.
Right.
It's new. I didn't see this 5 years ago, but and I don't know why. We can go into the speculations, the rabbit hole of the conspiracies, but at times it doesn't matter. If I see it every day and it works for me, just use it.
what you just explained to me sounds kind of like the 3 drives. I don't know if that's something you've heard of. The 3 drives pattern. It's another thing that ICT will teach. It's the 3 highs. So there's a high, that high gets swept, comes down, and then that second high that got made gets swept. So you've made 3 highs now.
Look, so today I think a video went live on my channel, and it was talking about how a head and shoulder pattern is a very nice mirror, simplified mirror of a Waqar theory distribution. The price action will be the same, you just label it different. And then I will come on and say how I explain it, and I'll give my reasons for it. But I've just labeled the same price action different to a Waqar trader who's traded different to a pattern trader. So I think in the markets, everyone has their flavor of like how to describe things. And a lot of the times we're just describing the same thing. So this was 3 drives, sounds like a distribution to me.
Yeah, exactly.
Some people say it's an Elliott wave count, and you have your 1, 2, 3, 4, 5, and then your retracement kind of thing. So we're all describing the same thing.
Yeah,
basically.
it's different ways to solve one problem. At the end of the day, most of us get the same answer, So that's just the way it is. But some of these new terms that come out for like pre-existing concepts that have been around for so long. Like there's some new concept called CRT now, right? Which is I don't know if you've heard of it, but it is literally just a sweep of a high or a low, but it's been given a new name now. So I think it has to do with the shiny object syndrome too, right? To appeal to new traders, so somebody can build a platform off of it.
That's an interesting point, and we mentioned briefly off camera, which is that in my earlier days, I didn't have too much to look at online. The internet wasn't the same. There wasn't as much good content out there. Whereas when you started, and it's been a while now, 4 or 5 years that you started also, but the internet was significantly different, especially around COVID time. A lot of content was thrown there. So do you feel like now is, let's say 2024, is the best time to start trading and learn to be a trader because of the abundance of knowledge we have, or the catch-22, as you just said, which is a lot of marketing gimmicks and shiny objects and distractions, and it's the Wild West at times too, especially when we talk about Twitter and how crazy that can get. How would you feel like a new trader today and how they should navigate it?
I think it's a double-edged sword, really, because there's a lot of good information, but at the same time, there's a lot of bad information as well. So I think as a new trader, if you come into the market and you end up, following the wrong guy, or the wrong information gets put in front of you initially, then that's going to severely hinder your ability to become profitable in a short period of time. I think with the proper information in front of you, and there's a lot of it out there, like you just said, with the proper information and a proper mentor, I think that you can be profitable very, very quickly nowadays as compared to, you know, when I was, even when I first started, there was a good bit of information, but I chose the hard route, unfortunately. So it was a little different for me, but I think it's much easier now if you know what to look for.
Well, that parlays into my next question, which is a new trader, how can they spot who to look out for, who is worthwhile to learn from? Kind of a checklist of a spot a guru versus, you know, someone to trust.
Yeah. There's typically only one thing I look for. So a lot of new traders, they get attracted to the numbers that they see, right? Like the P&Ls that people put out. And it's cool. Like you can put out $1 P&L, 10,000, 50,000, whatever it might be. But the one thing that I look for is if you can call the markets live in front of people beforehand. That, to me, if you can do that, that's the differentiating factor between somebody who is a proper trader who knows how to trade versus somebody who is obviously just marketing, right? Because people who are marketing, ideally, they can't really trade, so they won't publicly start calling the markets, right? You came on Twitter and you did it publicly, right? Because you know what you're doing. But then there's people that'll come on the opposite end of this, that'll come on and they'll just start posting like $10,000 days, $20,000 days, whatever it might be. And that's something that can be easily manipulated these days with, you know, Photoshop and whatnot.
Well, the reality is every single one of us can catch a winning trade.
Yeah.
Literally every single one. Even like a non-trader can catch a winning trade. There's nothing impressive about that. It's about the context of what happened before and after that trade. How many trades have you taken before that were losses? That context or a bit more longevity is the important one. Fair enough. When it comes to your journey, so you're 4 or 5 years in, you've started to transition now towards futures. How long have you been trading futures specifically?
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Futures now, it's been almost 3 years, but seriously trading futures, I would say it's been about 2, because it took me a little bit to get used to futures, right? I didn't know what lots were. I didn't know how much to risk. The risk is infinite. So I didn't know any of that. I came into it with the options mindset thinking, oh, whatever I put into it is the only, because with options you have that capped loss. On futures, you don't have a capped loss. So I didn't know any of these things. I had to figure it out.
Clarify that for me. So we have, in futures, our understanding is just a different market, but you trade it like FX, where you have your stop loss and that's honored. Mm-hmm. What do you mean by you have infinite loss?
So if you don't have a stop loss, if you don't put an actual stop loss order, you can lose an infinite amount. You can lose whatever's in your account can go away just like that. But with options, if I put $300 into a trade, even if I don't put a stop loss, it goes negative 100%. I'll only lose what I put into the trade.
Got it. Okay.
That was the difference for me. I didn't know that. So these were little things I had to figure out.
It was a transition. Yeah. Okay. And obviously now prop firms in futures is something that's pretty stable, it seems. A lot of US traders are forced to trade it and leave the FTMOs and the big firms because of regulation and so forth. So are you involved in prop firms? Is that where you are trading yourself?
Yes. So I do have a live account, but I think while the prop firms are around and they're paying people out, I think it makes more sense to leverage that, the capital that they can give you. It's way better, I think. So
yeah, we just had this small chat with Shinobi, the previous guest, and we were speaking about how that can birth a bit of a gambler's mindset, because you have that mental reset. You just buy another account and all these things. You're encouraged to kind of trade aggressively because it's not your money and so forth. In your experience, have you found any negatives that have come out from trading prop firms for the majority of your career?
On the opposite end of what Shinobi said, I think it's actually better to start off because of the rules that you have that are imposed
Okay.
against you. And I think it forces you to be more disciplined as opposed to you starting a live account with $50,000 and losing the entire thing, right? With these prop firms, because you have a daily loss limit, you have a max loss limit, and some of them have a consistency rule even. So you have to be consistent to get a payout. You can't trade one day and make $4,000 and the next day you make $200 and then try to withdraw that. It's not going to work.
Yeah.
So I think on the opposite end of that, I think that I think that makes sense. The degenerate mindset does make sense. But I think at the end of the day, if you have that mindset, it's gonna remain there whether you're on a prop account or whether you're on a live account.
Yeah.
So for me, I think that the prop firms actually helped me out a lot in terms of being a little bit more disciplined in my trading.
And have you found you are trading any difference on your live accounts, or you just kind of copy the same thing?
No, it's on my live account. I barely touch my live account right now.
Okay.
But on my live account, I try to leverage swing trades.
Okay.
So if I see my same setup form, like I trade the 4-hour PO3, there's a weekly PO3 as well, right? And a daily PO3, like every single
It's
candle.
fractal.
Yeah, it's fractal. So I will, on my live account, because futures prop firms don't allow you to swing trade, you have to be liquid by the end of the day. So for that reason, if I see a move, if I map out a move that on the weekly that I know is going to hit a certain level, I'll go take that on the live account and then just hold it. I'll log out of the live account. I don't open it until my stop loss hits or my take profit hits.
Okay.
So I trade it a little bit differently in that sense. I don't even day trade on that live account at all.
I had a guest on the show which said something to the effect of trading is the hardest way to make easy money. What I understood from that was like it's very hard for a couple of years when you're learning, and then when you got it figured out, you got your rules. It's just kind of a rinse and repeat. Have you found that in your experience? Because it seems like you just have your checklist, you have your A+ setup, you're going to get about one a day, you have your entry criteria, you have your exit criteria, everything is mechanical as it can be. Is it just now a rinse and repeat process, or day to day there is nuance and variations?
Yeah, it definitely becomes easier when everything is systemized, because it's just like a simple checklist to follow. It's like if this lines up, this lines up, this lines up, then there's a trade. If not, then there's no trade, right? It simplifies things. It takes the guesswork out of it, that's early on in your career. That's really most of it is the guesswork, and that's why it's so hard, because you have to go through the trenches to get to this point where now you have a system, and like you said, everything is mechanical. So you know what you're looking for day in and day out, and you've seen that setup 1,000 times before. So it's pretty easy to execute on it after you've had enough screen time.
As time has gone on, with the A+ setup that you have and the confidence behind it that you have, and the ability to obviously recognize it and adhere to it, have you considered modifying your approach to risk, doubling down on trades, and maybe if you're on a win streak, behaving differently? I don't know. Do you have any thoughts on modifying risk?
Yeah, so with risk and adding more size, I'll always enter my position with a small initial position. Like it's a very, very small initial position, and then I'll ladder into that. I'll like staircase entries into the trade. So as that setup goes and is giving me more opportunities to enter, I'll add more and more and more to that trade until it goes and hits my TP.
And those re-entries will also be A+ setups with the same amounts of risk, or then you'll have like the less qualified trades as the follow-through trades?
They might be a little less so if the trade already has momentum, if we've gotten that initial change in state of delivery has happened, and now we know that price is going to the opposing draw on liquidity, I'll start staircasing at, if we get a pullback into a 1 minute fair value gap, right? Let's say.
Okay.
I'll add an entry there.
And will that be new risk, or will that be you've trailed your stop, the new capital freed up as your guaranteed profit is the risk on the next one?
That's exactly right. So
there's kind of like a big go big or go home kind of scenario.
Right, exactly. Okay. Unless if that trade doesn't provide me with an opportunity to staircase into it, then I simply will just stay in whatever initial size that I got into it with, and that's it. Okay. That's the end of it.
Moving forward, your career, obviously, you're a young man, have a long career ahead of you. Where do you see your trading career going? What kind of goals do you have? Because it seems like you've reached a very stable place. It's just rinse and repeat. You've got your systems. Where do you want to take things next, or what are you looking at for any forms of growth?
Honestly, at this point, because everything is just so systemized, I don't see myself straying away from what I'm currently doing.
Okay.
Probably just continue doing that. The only thing I could see in the future that may potentially happen is can't use prop firms anymore. If something happens, right, and you're not able to use prop firms anymore, the only thing that I could see changing is switching over to a live account, really.
Okay.
I think other than that, like at this point in my career, I'm very comfortable. Day in and day out, like I don't have any doubts in my trading or anything like that. I think the goal for me here on out would honestly just be to trade less, really.
Okay.
So instead of trading a 4-hour PO3, is start trading, like, you know how I mentioned I'm swing trading on my live account. I really just want to fully start transitioning into that, as opposed to coming and sitting on the desk every single day. And yeah, that's really the only switch I could see in my near future.
You mentioned a little bit off camera that you learned the hard way, which was, I guess, not with strong mentors. It was more trial and error and so forth. And you made it sound like it was a crutch, like it was I wish I had a mentor and so forth. And I can understand where that's coming from. But what I've also found is, in my own journey, I've had the biggest growth through trial and error. Even if I had the information and then went on and did my own trial and error, you always grow more through the just figuring things out, being involved, being in the, your intuition is something real. Taking losses, the emotions that come with it, you learn from that. You get your own experience, you get your own market IQ. All of these things that are priceless, that can't be given. And I forgot who said it, but it was something to the effect of, look, the best place to learn is just get a cheap evaluation, get a cheap prop firm accounts, and just keep trading them. You'll lose them, but you'll learn a lot of lessons after you've blown 20 of them, but it's not going to break the bank kind of thing. What is your thoughts reflecting on your journey where you could have had a mentor, and maybe you've had mentors now, or you've seen the effect of mentors on people, versus your journey, which is more rugged and doing it in your own hands? Do you regret it? Do you think it was actually a better way? How's your views on that?
Yeah, no, I definitely think it was the way for me to learn. I'm naturally a pretty quick learner, so whenever I took these losses, it's not like I would just continue making the same mistakes. It's just things that I had to learn through trial and error, all these different strategies that I tried, and how long it took me to find a strategy and resonate with that and stick to it. But I do genuinely think that it's one of the best ways to learn, as opposed to having a mentor. Having a mentor is great, and it'll significantly lessen your learning curve. Yeah. But no, I really have no regret. In fact, I'm glad that things happened the way they did, to be honest, because I don't even know who would have been my mentor at that time, to be honest. There's nobody out there that
there is this thing called survivorship bias, which is essentially the guy that's standing at the top of the mountain, or a guy on a podcast saying, hey, this worked for me, so therefore it should work for you. But it's very easy to overlook your unique situation. Maybe you're particularly intelligent, maybe you're particularly quick learner, as you said. There are certain advantages that you have that someone else that might follow your blueprint, that doesn't have the same mind, will not get the same results. So it's easy for the guy at the top of the mountain kind of thing. There's a trader that I had on the show, Mark Hutchinson. He's a big trader from the UK. And his approach was that if a system is truly mechanical and it's not discretionary, it's just checklist based, seeming like as yours is, that if you just gave that to 100 traders, the only reason some would be profitable and not be profitable is the mind. It's the proportion of psychology, even if you give them a checklist. And I did find an interesting mental exercise to say, if it is black and white, it's just wait for these rules. But some people just mess it up. Some people just not be able to follow the rules. In your experience in a checklist-based system, how important is psychology as opposed to it's just mechanical, there's no need for emotion, let's just follow the plan? Does psychology come into it?
Yeah, 100%. That's the main issue that it's funny you say that. It's the main issue right now that I see across a majority of my students. Because things are so black and white, you have a checklist to follow, but somehow people will still mess it up. I have a student that followed the checklist, traded perfectly, was $6,000 in profit in his funded account, and then in 2 trades blew it completely, right? Because psychology was messed up, and that revenge trading, over trading mindset takes over, and it completely screws you over. So yeah, 100% psychology I think is I think without you can have a proper system, but without proper psychology, you're not going to be able to execute well. Is my thoughts on that. I think psychology is a huge part of trading.
What parts of trading psychology is important? Because trading psychology can be a very broad term. What would you say is worth focusing on?
I would say discipline is definitely number one, because without proper discipline, you are never going to be able to stop over trading, stop revenge trading, and stop doing all this stuff. And then for me personally, the part that helped me fix my psychology, turn it around completely, was the detachment from money. Because when I came into trading at that time, I was attracted to it because of the money, obviously, like most people are, especially nowadays. And that was what was screwing me over the entire time, because I was entering trades and my whole mindset was like, oh, I'm going to make thousands of dollars, every single day. That was my mindset. It was always about the money. And when it changed was when I started focusing on a proper setup as opposed to the money. So there was little things that I did to help me take my mind off the money in the options world. You can turn off your dollar P&L. So I would never see my dollar P&L. I only saw a percent gain, and you can calculate it, sure, if you really try to, but I would never try to calculate. I would just see 20%, 30%. I don't even know how much I'm up dollar wise. In the futures world, even now to this day, I trade with ticks. So I have ticks on my chart, on my trading view, as opposed to the dollar amount. So still it's something that I do, and that detachment from money is what changed my psychology completely. So I think those two things are super, super important. A majority of your psychology issues come from attachment to money. Greed, attached to money, revenge trading, FOMO, whatever it might be.
So in my limited understanding of psychology, what I've understood is that you have money, there's money anchors, whether that's a desire for money, whether that's fear because you don't have enough money, whether there's greed because obviously it's money anchors. And then the other one is just unfavorable outcome. So you move your stop loss because you don't want your stop loss to hit. So you're willing to lose more money and all the negatives that come with it because of an unfavorable outcome. And another one could be like you revenge trade because you don't want to accept the loss. So you don't want to settle this unfavorable outcome. So it's both of these things that are, I would say, the major pillars. It seems like you were solving these with a bit of techniques. Let's say you turn the dollar amount off and you put a percentage in. And whilst these little tricks can be helpful, I'm interested to know, was it your outside life as well that was contributing to it? Because I'm sure if I give every trader that has psychology issues this trick, they will still mess it up. And it's because maybe their situation at home, or maybe the money problems because they're in debt, and the other anchors of the reality of life. What are you doing in your life that's bringing you comfort into the markets?
I think it's so a lot of it early on, I was super, super undisciplined coming into the market because I was just undisciplined as a person. I was a teenager, and that's when I came into the markets. And as a teenager, I wouldn't do anything, right? I was super, super undisciplined. And then what a lot of people don't know about me is that I went and I joined the army, and that's how I built a lot of discipline from being in the army, right? Because the army is literally based around discipline. If you don't wake up at a certain time and do this at a certain time and do that at a certain time, like, you're screwed. So joining the army helped me a lot from the discipline side of things. And being in that environment, I think, especially early on in my trading career, helped me a lot. Other than that, now that, having gone through that discipline side of things has stuck with me, and having a proper routine every single day, waking up, having that routine of, waking up at a certain time, closing the charts at a certain time, because usually after like 12, I leave my desk, I'm done. Unless I have other work to do, whatever it might be, it's not chart related, I leave. Like, I physically leave my house usually most of the time. Whether I go for a drive, I hang out with one of my friends. I'll come to Shinobi. I'll drive an hour and a half and go to Shinobi's house just to be away from the charts. Yeah. And that helps me out a lot as well.
A powerful statement that I keep in the back of my head, which is, psychology is important, but I don't give it too much weight. And the reason I say that is because obviously it's preferred. Like, if you can master your psychology, you're going to be bulletproof. However, if you have bad psychology but your behavior is good, that's actually what matters. And the reality is you have people that focus on their psychology, they focus so much on their morning routine, but still do the wrong things. So no matter your mental state, it's your behavior that counts, and vice versa. You could be in a chaotic state, as you might have taken 3 losses, you might be in a chaotic state, but then you exit the situation, so you can't do the wrong thing.
Right.
And sometimes just behavior trumps your mindset. And long term, obviously, is something you want to solve. Now, you've just given me a revelation, which is you were in the army. I didn't know this. So talk to me about going from the army to being a trader. There's got to be some interesting stories in that.
It's very humbling because, especially early on in your career in the army, you're like nothing, right? You're literally just a number. Like nobody cares about you. You're not really valued in the army. So, I mean, when I was trading options and I was making a lot of money, I would be making like $10,000-$20,000 in a day in a trade, and go to drill and clean toilets. You know what I mean? So super humbling, and it kept me level-headed throughout my entire career in that sense. So I think it was actually good for me. Otherwise, I might have just lost my brain and like went and did some, whatever people do.
How did you decide to leave and actually transition into just being a trader?
I'm still in, but I'm part time. So
I see. Okay.
yeah. So I go 1 weekend a month. I'm in the National Guard now.
Oh, so you still got your discipline, your regimen.
Yeah, it's still there. It's still there. It really keeps me level-headed because going there and having to do things that normally people in my position would never even imagine doing keeps you at a keeps you down here instead of up there.
So is that why you choose to stay participating in it?
Yeah, I think so.
Okay.
And it's something my dad always wanted me to do for some reason. My dad's like this super.
No way.
Imagine a brown guy, and
my
he's
dad wanted
like,
me to be a doctor. That's all he.
No,
Okay.
yeah, imagine like a brown guy, but he's literally white. It's crazy, but
Okay.
yeah, no, he has a big passion for it. And then one of my friends joined, so it kind of made it enjoyable. I did a fun job. I did infantry, so I literally go on the weekends and shoot guns sometimes. It's kind of cool.
Okay.
So
And those active weeks that you have, are you trading during that time, or is that off time from the market?
it's difficult, but I still try to trade. I end up trading London, late London, because we're waking up at like 4 a.m. So if we're not doing anything right away immediately when you wake up, but I'm only gone for maximum 2 weeks.
Okay.
So if those 2 weeks, I was just gone in June for 2 weeks, and those 2 weeks I was literally just trading London. I would wake up at 3:30, 4 a.m. and trade that mid London session.
Yes.
I wouldn't even. I had no ability to trade New York usually because we're doing something actively, so it was impossible. But
Fair enough. Well, I think we had the first military man on the show. That's pretty sick. Yeah, bro, Harris, thank you very much for coming on.
Appreciate you for having me
episode and exploring the things. And what I found is I've had a lot of guests that maybe you don't even know who they are, but a lot of commonalities. And what I found is the guys in North America, Canada, and here, all actually very similar, which is at least interesting to me to see that you all think in a very similar way, trade in a similar way, and that's probably down to, I don't know, social media or belief system and so forth.
Yeah.
But bro, thank you very much for hopping on. It was a good one.
Appreciate you, man.
Cheers, bro. Boom.